Hey guys, welcome back to the channel. So as I mentioned in the previous little intro video I did, I'm actually a licensed mortgage broker in Ontario. So I figured I would put together this short little video on just how exactly mortgage qualification works. I've had a lot of questions from people about what they can do to really ensure that they're going to be able to get the financing they want when they find that dream property or when they find that particular investment property that they would just love to purchase. I'm going to cover the 3 C's of credit, a bit of the stuff that you're going to be able to actually do to make it so that when you actually apply for a loan, you're going to have the best chances of being approved. And I'm going to cover just exactly what does a mortgage broker do. There's a lot to cover, but I'm going to condense it all just so you can kind of get a bearing on what exactly it is that you should do if you're planning to purchase a property in the future, and what you can do now before you go and actually apply for mortgage financing. Real estate as an industry is a highly leveraged business, and what that means is that for every dollar you're going to be bringing to the table, you're going to be looking at a mortgage lender to bring 2 or 3 times that in the case of conventional mortgages, or up to 19 times that in the case of high ratio or insured mortgages. Since you're bringing so little to the table and you're looking at these lenders to bring so much to the table, you can quickly see that how these lenders see you is going to be really important in terms of growing your real estate portfolio. Lenders work off something known as the 3 C's. There's character, capital, and capacity. Capital is going to be your down payment, and I'm going to primarily deal today with conventional loans that are going to require 20% down, which is for every $100 that the property's worth, you're going to bring $20 to the table and the lender is going to bring $80 to the table. Your credit history and your report is going to be what really shows these lenders your character. It's going to be your history of repayment, if you're ever late on payments, if you've ever flat out refused to repay, if you had any judgments or any bankruptcies on your file, and just how much you're currently borrowing and what the requirement is going to be to service your debt monthly. Now, as a real estate investor, I'd recommend that you stay on top of your credit file. There's 2 main credit bureaus in Canada. One of them is TransUnion and the second one is Equifax. You can request your score from them for free. However, I believe you can only do that once a year. And I would recommend that you check your score 2 or 3 times a year just to make sure that everything on your file is going to be accurate and you know where you're sitting in terms of your credit profile. Scores from 660 to 900 for Equifax are typically considered good to excellent. There is not going to be any sort of magic number that is just going to open the doors to all the financing you want. However, having a score above 680 is really going to mean that most lenders would be interested in lending to you. Now, having a credit score that is below 680 is not going to mean that you're not going to be able to buy real estate. What it is going to mean, however, is that when you get financing or you go to apply for a mortgage, you're going to be quoted a much, much higher rate than someone with a good credit score. It's not going to rule you out of the market. However, it's going to mean that your cost of credit is going to be that much higher than the next person. Now, as we said earlier, since real estate is such a highly leveraged industry, the lower you can get your borrowing costs, the more competitive you're going to be when you go out and actually bid on properties. That's why it's very important that you work on improving your credit score if you have bad credit. The next of the 3 C's is going to be capacity. Lenders are going to look to see what you're making in annual income, and they want to see consistency. If you made $100,000 this year, but last year you made $20, that's not going to be a consistent amount. And lenders are not going to say, well, this person is likely to be making $100,000 every single year from now into the future. If you made $50,000 last year and $50,000 this year, then lenders are going to say and see that you have a strong history of employment where you're making consistent amounts of money, and they're going to base your loan off that. In Canada, we work off 2 different ratios. One of them is the GDS, and the second ratio is known as the TDS. The GDS is the percentage of your household income that needs to go towards housing-related expenses. Now, housing-related expenses are those that are directly related to your housing. In Canada, that's going to be principal, interest, taxes, and heating. And in the US, I believe it is principal, interest, taxes, and insurance. In Canada, this ratio should not exceed 35%. Taxes are going to be the annual taxes divided by 12. Heating is going to be an estimate for the heating costs of the property. So what exactly is principal and interest? Your mortgage payment, although it's one payment, is going to have two key components. That's going to be principal and interest. The principal portion of your mortgage payment is going to go towards paying off the balance you owe. The interest portion of your mortgage payment is going towards paying off the accrued interest on the mortgage loan that you hold. Okay, so now that we know what principal and interest is, now we have to figure out how exactly do you calculate your mortgage payment. In Canada specifically, we have something called a mortgage stress test. And this just means that when you go to qualify for your mortgage, they're going to put in a higher rate than what you're actually going to get when you do get the mortgage. This is just to ensure that if rates were to ever increase, that you would still be able to afford to make your payments. At the time of this video, the stress test rate is 4.79%. So I'm not going to go into the math for how you would actually calculate your mortgage payment. When we take into account the interest rate and we take into account the amortization, we're going to work backwards to figure out what payment you would need to make each month to ensure that the balance owing, whether it be at the end of 25 years or 30 years, is going to be zero. I've gone to my website here. You can just click on home purchase, click on home purchase calculators. We're simply looking for the mortgage rate and payment. So we're just going to set the mortgage amount to $100,000 to keep it simple. The mortgage amortization is set to 25 years. And as I said before, this is simply the time it would take to pay this mortgage balance off to zero, given how frequent you're making a payment and the interest rate. We're going to put the mortgage rate in for 4.79%. That's what I said was the hurdle rate. That gives us a mortgage payment of $569.71. So I've made this little spreadsheet in Excel. So I put in a monthly income of $2,500. I've put in our principal and interest payment. I just rounded up to $570 to keep the math simple. I've put in a monthly expense of $100 for taxes and $100 for heating. We have $770 a month is going to be our principal, interest, tax, and heat payment. Our GDS ratio is going to be 30.79%. Since this is less than 35%, this would qualify. If we reduce the income monthly, however, down to $1,500 a month, we can quickly see that our gross debt service ratio shoots all the way up to 51.31%. That's because our total housing related expenses are $770, which is more than half of what our monthly income is. If we bump our income up to $3,500 a month, we can see that our GDS is a healthy 21.99%. Now the TDS is going to take into account all of the stuff that's involved in the GDS. However, it's going to add into that equation all of your other debt obligations. This is going to cover your credit cards, student loans, any other revolving credit you may have, like lines of credit, and car payments. Typically in Canada, this ratio should not exceed 42% of your income. As we can see, our TDS ratio right now is the same as our GDS ratio. And the reason for this is because we don't have any extra monthly debt expenditures currently put in. If we were to put in a car payment of $250, a minimum payment for credit cards of $100, and student loans of $180, we can see that our total debt service ratio is now 37.13%. It's still below 42%, so in this case, this person would qualify for this mortgage of $100,000. Now, if we were to reduce our income to, say, $3,000 a month, we can see that our total debt service ratio now is sitting at 43.32%. However, our GDS ratio is sitting at 25.66%. So this deal would qualify based off of the GDS, but be rejected based off the TDS. This is a situation where this individual would have to go and, say, pay off their credit cards and immediately now their ratio has shot down to 39.99%. So in this case, this deal would get approved. As you can see, having additional debt expenditures and commitments is really going to reduce what your affordability is going to be. I often see people that did not necessarily have the forethought and got themselves locked into a very, very hefty car payment that completely erodes their affordability, and they have to somehow either boost their income or get rid of that car payment just to allow them to qualify for the funding that they're looking for. Now, some lenders, depending on the type of property you're purchasing or your employment information, and also depending on the type of lender you're dealing with, may allow you to go slightly higher on your TDS or GDS ratios. These are known as expanded ratios. Not all lenders provide them, but depending on the type of property that you are purchasing, you may be able to actually get a product that allows expanded ratios. I'm not going to go into detail with that today, as that's going to be a bit more involved of a topic, as it's not a widely available program. Only some select lenders are offering it. But if you'd like more information, I will leave my email down in the comments, and just feel free to shoot me an email. I'll get you information over for lenders that will offer expanded ratios in your area. So what exactly is a mortgage broker? A mortgage broker is a broker between lenders and between those looking for funding or financing. There's a whole host of different lenders that offer mortgage products all throughout Canada, and they all each are looking for a different type of customer. That's why it's important that you find someone who knows lenders. It's our job as mortgage brokers to match lenders looking to lend on investment properties with customers looking to get mortgages on investment properties. This is going to give you access to products such as expanded ratios. It's going to give you access to products such as rental offset or add back, and it's going to really allow you to strategically grow your financing and grow your real estate portfolio. So that basically sums it up. That's exactly what a mortgage broker does. If there's anything I missed, just leave it in the comments below. I'll check back frequently so I can answer. I'm going to make some more future videos about things such as rental offset and add back, and how one of them can really mean the difference between growing your portfolio, and the other one really mean the difference between having your portfolio cap out at 2 or 3 properties. I'm going to do a follow-up video that's going to include how mortgages work for insured mortgages. They work pretty similar, however, there's going to be a couple key differences in terms of down payment and the addition of mortgage insurance. In Canada, that's CMHC or Genworth Financial. This video was mainly targeted towards people that are going to be looking at putting 20% down and getting investment properties. Almost forgot, one of the most important things you need to do if you're looking at getting any sort of real estate financing or mortgages, or you're looking at growing an investment portfolio, is to smash that like button and hit subscribe.